Hi everyone, and welcome to this week's episode of Kickstart Your Real Estate Investing. In this week's episode, I wanted to cover different financial options you have when you try and buy an investment property. So as you must have seen in previous episodes, when you underwrite a property, one of the biggest expenses you will see is going to be the interest you pay on a loan which you will take for buying an investment property. So it's very essential to know where your money is coming from when you go and finance that particular property, because that has an impact on your cash flow and has an impact on your bottom line in terms of how much money you would make when you sell the property too. Okay, so what are the different investment financing options you have? So obviously the first one obviously is you go out and buy everything on cash, right? You do an all cash purchase. Obviously that's not something I would recommend to anyone starting out and investing in real estate, because it carries a lot of risk and you're basically going and putting a big chunk of money to buy a property and then hope that it will work out better for you, right? So that's definitely an option, but not something which I would recommend. Then you fall into another option, which is basically going and trying to get a conventional loan. This is your 15-year fixed loan, a 30-year fixed loan, and that is a preferred option. But if you look at a climate like this, where there is a lot of interest rate issues going on in terms of the fluctuation in the interest rate is going up quite a bit, and there is prediction that it might even go further up. So that option is the safest but may not be the most economical in terms of the cost you will pay for the interest rate and the interest which you will have to pay out of your gross income. Okay, so that is obviously an option. Then the third option, which is going to be, is around adjustable rate mortgage. This is a more riskier option, but gives you an opportunity for trying to delay the increase of interest rate over a certain period of time. There are like 1-year arms, 3-year arms, 5-year arms, 7-year arms. So you can decide based on what your risk appetite is and how much runway do you have before your property will stabilize and it will give you that kind of income where you can even afford to go to a higher interest rate later. We'll cover all that in future episodes. This is just giving you a high level overview of different financing options you have. So after the next one, obviously you could get into something like a joint venture where you and a few of your friends could come together, pool money and buy a real estate property. Now it also has its pros and cons, so you definitely have to look beyond the money which is brought in, whether everything can work together, whether you all have allied interests and everything is aligned towards having that property with similar interests and similar goals. Okay, so that is also one other option for you. And finally, there is also an option of hard money lending, right? Where you basically go out and there are hard money lenders who will charge you very high interest rate, but will give you the money which you can invest in. But as long as you have a fallback plan of getting your funds from somewhere else and quickly paying off your hard money lender, this is definitely a very expensive option. And finally, when all of those things fail or you do not have those options, there is also the aspect of seller financing. So that in itself is a very interesting option where the seller is basically vouching that you are the one who is still going to be able to pay him the mortgage interest, principal and so on, and the seller is the one which is carrying the mortgage for you, right? So there are definitely those options too. So we'll cover all those things in the future episode, but for this one, what I wanted to give was an overview of different options you have from a financing perspective. Now, when you look at all this option, you have to look at 3 criteria which will help you decide which financing option you should go for. The first option is obviously going to be, what is the strategy around this? Are you doing something to buy and hold? Are you doing something as a flip? Or is it more like a short-term rental which you want, where you're going to have a very high cash flow very soon and you are basically turning in a lot of money, right? So you might want to see what is the strategy in terms of the property you're buying and what is the investment style there. The second thing you have to look for is your risk appetite, right? Are you more risk averse? Then you need to go towards 15 or 30-year fixed where the interest rate does not change to the life of the mortgage. Or if you're able to handle a little more risk, then you might want to look at ARM products or hard money lender, which you can take for a little period of time and then turn around and then basically go and get a better mortgage later, right? So definitely your risk appetite plays a role to it. And finally, the third thing which plays a role in it is how long you plan to hold that property, right? So if you plan to hold the property for, let's say, 15 years, then you may not want to go with a 3-year arm, because after 3 years, you will have to take the decision of whether you want to go and refinance this what is this market situation at that time? Are the interest rate higher, lower than the ARM rate? So you'll have to think about all those things. So the amount of time you plan to hold the property also plays a big role here. Right? So folks, this is basically an introduction of the different financial options you have. In the later episodes, I will go into details of each one of them so that you are able to choose the right financing option when you buy a real estate investment property. Okay. Hope this episode was helpful to you. And if you like it, then please go ahead and like and subscribe to my channel. And I'll see you next week where I go into details of each of these options. Okay. Thank you. Bye.